Welcome to FinFacts Live. Today I'm joined by special guest, Mr. David Pascale.
Hello.
And today we just want to dive into a few quick notes. David has been writing for our FinFacts for decades. David, how long have you been doing this?
About 30 years.
Only
FinFacts.
30 years.
Yeah.
Man, it's incredible. And so hundreds and hundreds of articles David has written. This one, the one we put out on June 26th, Friday, very good article, very apropos given the regime change that we just had in the Fed. Today, we had a big Supreme Court ruling upholding Fed independence.
Yes, we did.
And, maybe we can dive in a little bit, David, on some of the sticky inflation that we have. And I'd love to hear your call. Like, what are we going to see? So let's just dive right into it. So June 16th, we had a regime change at the Fed. So what happened?
So we have a new Fed chair, Kevin Warsh, and he immediately put his stamp on the Fed right away on the opening statement. It was much more brief, and he is also very much against doing forward guidance, like the dot plot. He does not like. He doesn't like any types of guidance being delivered for the future. He wants the Fed to be to always be using current information and not any predisposed notions. So he started out that way by not putting his own dot plot in. So Fed Chair Warsh did not show a point where he is predicting where rates are going to go, that all the other participants put their dot plots in. So what he is basically saying then is, I have the most important vote and I'm not in the dot plot. So right away, he's diminishing the importance of the dot plot. And I welcome this, because that way, something can change between now, as we know, and 2 months from now. So
he has said that the Fed is unambiguously committed to price stability.
Mm-hmm.
So what does that mean for our real estate borrowers? Most of our listeners and clients of our firm borrow money because we're in the business of real estate. So what does that mean?
So, the baseline for almost all loans is the 5 and 10-year Treasury, as opposed to floating rate loans for permanent loans, permanent financing. It affects the up and down in Treasuries, affects rates, and it affects cap rates, and it affects the yield that every sponsor gets on a purchase. It's because it affects what their interest rate is. So it is front and center. Treasuries are the index that is the basis for most commercial mortgage interest rates. Treasuries are often based on the Fed funds rate and where the Treasury investors believe the Fed funds is going in the future. The other thing about Treasury investors and the buyers of Treasuries is they want to know that the U.S. that is issuing the Treasuries is not having issues with their currency, meaning hyperinflation or inflation at all. Inflation creates a situation where each dollar is worth less. So that means that they would need a term premium, Treasury buyers, to make up for that inflation, creating higher rates for all of us. Low inflation gives Treasury buyers and the Treasury market confidence that that dollars are going to be strong going into the future, and they don't need to add a term premium. Therefore, it keeps our Treasury rates lower than they would be without that.
Yeah, and so let's switch gears a little bit into Fed independence. This is something I know you and I have talked a lot about, David, and you have some very strong views here. And I think it's important to cover it because this was not necessarily in your article because the news kind of broke this morning. But today, the Supreme Court ruled just 5-4, so a narrow ruling, that Trump cannot immediately remove Lisa Cook. So.
Yes.
And Chief Justice Roberts further singled out that the Fed has a unique historical status. And this comes right on the heels of Warsh's own sort of declaration of independence that he gave for the Fed. So what does this moment mean for Fed confidence, you think, for markets? And ultimately, what does that mean for rates?
It gives the world and investors around the world some confidence that Fed independence will remain, and so that they can be confident that their investment in a treasury is safe. The Lisa Cook decision today is interesting. It was 5-4, and some of the decision was involved the concept that this is not the Federal Trade Commission or the Department of Education. This is a critical piece of the United States hegemony around the world. Our projection of our soft power.
And also influenced by other potential external factors, right? Bankers, et cetera.
Right. And so the currency buyers around the world want to know that the rates are not being manipulated, and that after we left the gold standard, that we would keep a lid on inflation. So the fact that we're not on the gold standard anymore means that our currency is only worth, the amount of currency out there, call it M1 and M2. So when the Fed starts to lose the battle on inflation, that means there are more dollars out there buying the same amount of goods and services, which means that the dollars are worth less. So it's
right.
This bit of Fed independence is very important.
So Fed independence, very important. Sticky inflation versus a market that looks past it. So PCE just printed at 4.1, which is the highest PCE we've seen since, I think, early 2023.
Yes,
so
it is.
We're seeing some inflation. I know anecdotally, David, we've seen it in some real estate deals recently, kind of at the closing table with GMPs, so contractor pricing moving around at the last minute, et cetera. Some of that's pushed, or some of that may be related to excess demand for certain trades like electricians, et cetera, who are staffed on higher paying projects. Could be a data center, something like this. Some of it's as a result of oil prices going higher. So how do you kind of reconcile in your mind, David, the sticky inflation that we're seeing with the Fed signaling resolve and consistency to the bond market? Is the bond market going to shrug this off? What's going to happen?
Well, the bond market wants to see, obviously, the Iran war situation calm down, and then they could possibly see where inflation is outside of volatile energy markets. And yes, a lot of trades keep spiking, a lot of trade costs, a lot of employment costs, a lot of services costs are still hotter than the 2% Fed target. So there's going to be a lot of focus on PCE and PPI and CPI going forward. But also let's note that the Fed started a new committee. Warsh and the Fed have a new committee regarding survey methods. And a lot of observers are noting that these surveys are outdated. People don't respond to them. It's lagging info. Another thing that hurts credibility are the endless revisions. So this is going to be a really interesting committee. They're going to evaluate new information, like, Evan, you and I like to look at Trueflation, which is another data set out there, and they might use some private sector data and also reform the survey methods, and maybe use credit card transaction data, ADP data, satellite imagery, watching trucks moving around. And so we might see a new paradigm on the data. And going back to Fed independence and Fed credibility is, there's still, a feeling out there that Treasury buyers don't want to see the Fed abandon the 2% inflation target, because that might be seen as gimmicky or even worse, a surrender. So they're going to be walking a very fine line in retaining the old ways and coming back to a 2% target and also bringing in new data.
That's right. I for one am very excited to see what the committee comes up with and what the practical implications are. I don't know if this is true, but I think there's something between 800 and 1,000 PhD economists, et cetera, at the Fed, PhD level people. I mean, that's a lot of brain power, and which is great. But at the same time, it's interesting to me that there are companies, hedge funds, et cetera, that are probably a step ahead measuring these things than that group of people. And so it'll be really interesting to see what we can do with technology, this different survey methods that you mentioned, some true hard and fast data that maybe we can glean and get some better numbers. It seems kind of nuts that we print the new statistics and then have massive revisions. Like,
yeah, exactly.
It's not like you're going,
to
0.5% or something. Right. Like the revisions are as large as the headline numbers. What else are we missing here?
Another interesting task force or committee that Warsh has started, is Fed balance sheet size. And this could come into play. After the GFC, the Fed increased their balance sheet, which forever, on in through the 1900s, had been about 1,800 billion. It immediately went up to 5 trillion and as high as 8 trillion during the GFC and during the bond buying. So, the issue there is if you lower the balance sheet, which Warsh has been an advocate of, too quickly, you remove liquidity from the financial system, because by selling bonds, you now have the private sector buying those bonds, and it crowds out other forms, other instruments. So it's going to be walking a tightrope, because a key part of the Fed's ability to modulate the economy and to modulate inflation is through the ample reserves. And ample reserves means just what it sounds like. There are plenty of reserves in the banking system. So when the Fed reprices those reserves using the discount rate, there is an ample supply and there are no supply-demand imbalances. If you cut down the reserves in the system too quickly and then there's a scarcity, then you will see the Fed lose control of rates and rates spike on supply-demand issues. So I would watch this Fed balance sheet quite closely.
Yep. I think this is going to be an interesting one to watch play out. Well, David, as always, this has been a pleasure. For everyone listening, make sure you read David's column. He's been, like you said, he's been doing this for 30 years, and a lot of people listen and read it. So you should be too. So gspartners.com, sign up for FINFacts. David, what other little words, any other words of advice today?
I would say, we're in an era of, we're going to be open to new possibilities. So I think market participants need to be open to these new possibilities also. And it's going to be a rethink.
Cool. Thanks, David. Okay.